Hello, Steve Lentz here with Discover Options. Welcome to the Prepared Mind. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Folks, we have two reports for you today. The S&P 500 Condor Butterfly Timing Report. That'll help you understand whether it's a good time to participate in range trading relative to just randomly picking any day out of the month. The second report is the Directional Likelihood Report for the S&P 500. We're going to show you, based upon Friday's close, the likely direction that the market will go, up, down, or drift around in the middle. And so stay tuned for that. Before we get to those reports, you should know that this is the video blog that corresponds to Frank Fahey's text blog at discoveroptions.com. Click on the blog link. Frank's report is awesome. It has a lot of earnings opportunities and volatility information there for advanced options traders. Take a look. You won't want to miss that. We'd love for you to subscribe by clicking on the button below. You'll get alerted when we post new stuff. Also, if you want an ebook, we can offer that to you by clicking on the link in the above right. Okay, on to the reports. Let's go to the first, the Condor and Butterfly Timing Report. I'm going to just tell you a little bit about why we like to do this report for advanced range traders. I'll get into the methodology a little bit, and then we'll talk about the current condition and edge level that we have right now. Why do we do this? Well, if you were looking back at the end of December, you could see clearly the S&P 500 was trading in a range, and if you had run the December 31st through our process, we would have ascertained that there was a negative edge. A negative edge in terms of selling premium neutrally through condors and butterflies. Now, what that negative edge means is that at that time, there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. All right, now wouldn't it have been nice to have known that at the time? Because boom, look what the market did, and you didn't get enough premium to really help you deal with all that movement that ensued after that. So let's take a look at the market condition, and what our goal here is to take this market condition and understand this, whether it's an advantageous time. So here's the current market condition as of Friday's close on the 8th. Price action. Thursday was an upswing day, and Friday was an upswing day. 2 straight upswing days with higher highs and higher lows. All right, and then the close on Friday was higher than Thursday's. We're above the 50-day simple moving average. Also, in terms of the overbought and oversold, the stochastics 15.3 is between 60 and 99. It's really kind of up there in the 90s. But I like to give it a range to determine the market condition. We're above the moving average, that 3-day simple moving average on the stochastic. And then Friday's day was kind of a higher than usual average true range, higher than usual range day. So that's the market condition we're in. And you know what? If you were to go back to January of 2000, how many times has this occurred in the past? All right, and that's really what we want to do, is look at the past and then ask ourselves, is out of those times that it occurred, can we tell if this current condition is a good one for selling option premium through range trading, butters and condors? That's kind of where we're headed here. So the methodology that we use to do this is that we look at the 21-day actual percent move. And real quick, we'll get through this and then get to the report. You can pretty much tell by looking forward how much the market moved. In this case, the market ended up moving roughly 2.4%, and we make that part of a little indicator here. Now then, if the market moved 2.4% in this example, at the time, what was being implied, what market move was being implied by the option prices? And we're going to compare the two. How much did the market move? 2.4%. What was being implied by the option prices? In this case, 4.4%. So the option prices were predicting a much larger move than what actually happened. That would have, in hindsight, been a great time to sell premium through range trading, condors and butters. So we're going to paint that bar blue. In fact, all the bars where the implied volatility was higher than the volatility that ended up actually happening, we're going to paint those bars blue and call those favorable. Those are favorable for selling option premium. Bars that are red are bars where the implied volatility was lower. The options were implying a volatility that was lower than what actually ended up happening. And those are unfavorable for range trading. All right, so what we're going to do is we're going to look at what percentage of all the bars are favorable. I think that's helpful for us range traders. Of the bars, and then we're going to shelve that number, and then we're going to look then at the bars that match our current market condition and what percentage of those were historically favorable for selling premium. The difference might represent an edge. So look at this information. If you were to go back to January of 2000, you would discover that almost 2/3 of the bars were favorable for selling premium, where the volatility implied by the option prices was higher than what actually came about. Roughly 1/3 of the bars were such that the implied volatility was predicting a volatility lower than what actually occurred. All right, 2/3 roughly, 2/3, 1/3. Now, if we were to take our market condition and look at the 122 instances where this same condition occurred, 2 upswing days into a highly overbought environment, with the Friday having a fat range day, okay, that's occurred roughly 122 times in the past. You know what? Of those 122, 73% ended up being favorable bars for selling premium neutrally. Not too bad. Now 73 is higher than the historical average. So we roughly have a trading edge, a Condor butterfly range trading edge of roughly 8.7%. All right, so that, and what we're saying here is that there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. So historically, at least, does that guarantee you're going to make money? Well, no, because roughly 1/4 of the time the markets are choppier than what's being implied. So there's no guarantees, but at least you know it's better than a coin toss, right? It's better than just picking that day out of the month randomly. So that's it for the Friday on July 8th, 2016. We have all indications that we have a better than usual likelihood that all systems are go for that, for selling premium neutrally. Let's go to the next report, the Directional Likelihood Report. Which way is the market going to go? What's it likely to do? Okay, before I get to that, I want to make sure you know that at Discover Options, we offer one-on-one mentoring to help you get through these concepts and develop your own professional level trading plan that can help you make money consistently. And we have a group of mentors that trade professionally. They manage accounts, and we want to give you that knowledge and give you the one-on-one attention that it takes for you to get up to that level that you want to be at. And we offer a variety of ways for you to dip the toe in the water first before you were to really go for it and get to the advanced level. We have introduction. We have just simple concepts here. You can go to the website at Discover Options and take a look. If you want to trade earnings, Frank Fahey has a great earnings announcement series. Our equity track takes you through the intermediate and advanced concepts, and then futures options. We have a wonderful track for you there as well. Go to the website, check it out. Give us a call if you want clarification, and we can customize a program just for you. All right, let's go to the likelihood report here. We review our current condition. once again overbought after 2 upswings, and then a big fat day there to top it off on Friday. Now, since January of 2000, we know this has occurred roughly 122 times. What direction did the market go every time we were in this kind of condition? If we were to go back and take a look, it would be nice to know if perhaps 100% of the time the market took off or it failed and went down. It would be nice to know what happened then when this same thing occurred in the past. So here's what we do to determine that. We're going to look at the historical distribution of price randomly from every close going back to Jan of 2000, and then we're going to look at the distribution of price after this condition occurred. We're not just going to check out whether the market was up or down after 5 or 10 days. We're going to look at a more comprehensive distribution model of prices to determine this. So here's how we do this. To determine the distribution of prices randomly by historical and then also for the condition, we're going to measure this by observing how often price touches one standard deviation volatility bands that are placed from each bar's closing price, 5, 10, and 15 days. We use a 20-period moving historical volatility to determine that width, and these are, of course, set one standard deviation from the close log normally distributed. Here's an example real quick. You have the close here. We're going to set the top band up here, the bottom band down here. And the question is, from this close, did price hit the upper band, the lower band, or fail to hit either one and wobble in the middle? And in this case, if we look, it immediately went up and hit the upper band. So in our database of distribution data, our distribution database, for that particular close, we record that price hit the upper band. Okay? Now then, let's go to this close. We note the band is up here, the band is down here. Did price go up and hit the upper, the lower, or wobble in the middle? Okay, and when we look real close, we would see that it hit neither of them. If you look real carefully from there to there, you'll see that it tried to come down and hit the band, close but no cigar. So in this particular case, we put in our database that it hit neither band for that particular close. And what we'll do is we'll look at the distribution like this. For every close, we're going to record how often price struck the upper and lower 5, 10, and 15-day bands. That's what we're going to look at. And here are the results. In the S&P 500, when you go back in time, it hit the upper 5-day band 29.6% of the time. The upper 10 and 15-day bands, roughly 23% of the time. Then it hit the lower 5, 30%, the lower 10, almost 30, and then the lower 15, 32.4. And that's over the course of 4,132 closes. Okay, so that's the random distribution, at least historical distribution, going back all the way to Jan 2000 through July 8th. Now what do? We look at the distribution after our current condition occurred. This condition here, we're going to look at the distribution not only from the close, but look at this, folks. We're going to look at the distribution of price if it goes above Friday's high here on Monday. We're going to look at what happened with the distribution of price historically if price went below the low of Friday. I think that'll be real good information for you to have going into Monday's. The recording topped off a little bit. Let me go back and just it just cut out and then it came back again. Real interesting. So the distribution we look at is as of the close, if price goes above the high or goes below the low on Friday. And so let's take a look here. At the close on Friday, we can see that out of the 122 times our condition occurred, okay, on the upper 5-day band, it hit the upper 5-day band 11.5 times, 11.5% of those 122. Historically, it hit the upper 5-day band 29.6. This means that it hit when our condition occurs, it hit the upper band 18% less often than historically, just the random historical. It hit the upper 10-day band almost 15% less often. The upper 15-day band 15.5% less often. And then on the lower bands, it hit the lower 5, 10% less, lower 10, almost 6% less, the lower 15, about 8.5% less. Clearly, it's hitting all 6 bands less often than normal. What does this mean? It means lower market volatility. Lower market volatility. We're not leaning bullish or bearish here. If it were hitting these bands more often than usual, then you would have a bullish or bearish bias. Here we are it's just basically lower volatility both on the upside and the downside. So anyway, just lower volatility in general here. Let's take a look. Of the 74 times that price went above the Friday's high, all 6 bands were touched less often. Same story. If price goes above Monday's high, folks, we have a similar situation where the market appears that it is more likely to be less. It's very likely that the market will behave in a way that is less volatile than normal. Okay, let's go now. What if price goes below the low of Friday? Okay, let me get rid of this. Boom. Oh, let me see just a second here. Let me just cast this thing back there. There we go. Same thing. All 6 bands got hit less often if it goes below the low. So no real change there. So the picture is quite clear. What I like to do sometimes is adjust the bands to be a little wider and reflect the skew adjusted VIX levels. All right, so the bands, instead of being based upon 20-day historical volatility, I'll base them on the VIX, and I'll skew adjust the VIX so that the upside volatility for the bands is lower than the downside, because we all know that the out-of-the-money calls and the options in the S&Ps have lower implied volatilities than the out-of-the-money puts. So I like to divvy them up that way, and I carve the VIX into 2 different volatilities, one for upside move and one for downside move. So the bands are farther out. The bands are getting struck less often historically, rather than 30% of the time. Now we're down in the mid-teens and up to 20, 21. Okay, same kind of picture. 5 of the 6 bands are hit less often here as of the close. If price goes above the high, again, getting hit less often across the full spectrum here. And then if they go below the low, this is if they go below the low. I didn't get the heading right there. But you can see 5 of the 6 are getting hit less often in that case. Okay, so I think it's pretty clear in terms of the likelihood, the market likelihood for price moving. Okay, this kind of says it all. All 6 bands are getting hit less often. It's likely that we're going to have lower market volatility moving ahead. Let's say you might be in the mood to sell premium and maybe lean this thing a little bit bullish, but yet you want to kind of treat it kind of like a condor. Here's one strategy we like, and we like 2 basic strategies like this, an offset butterfly and then a hedged bull put spread. And I'm just pointing out that we have the VIX set here, and I carve it up. The downside vol is at 15 when you skew adjust it, and then the upside is at 11.4. Now remembering that 15%, let's go to option view. And we plug in that 15% up here. Okay. And then what that does is it creates our standard deviation. What we do is do a bear call spread as our hedge, and then we come out to the edge of that standard deviation to the first strike after that, and we sell 5 units or five contracts. For every one bull or bear call spread, we do 5 of these that are out of the money, 20-point spreads. 5 times, this will bring in a positive cash flow so that no matter how much the market goes up, we're going to make money here. When you analyze this, you have a real decent little return if the market does go up. Okay, looks like we'll make 5% on our money. Not too bad, and that can actually be obtained in just a couple weeks if the market does take off. If the market goes down, our hedge kicks in and it lifts our risk line up here, so that even if the market went down, we can make upwards of 17% if we let it go to expiration. Not that you want to do that, but here's something encouraging, and that is when you look at the profit and loss price chart on this, you'll see with the market going up like this, all it has to do is wobble around a little bit or go up, and you're going to make some decent money here. Not too bad. To lose, the market would have to really take a downturn at a pretty good pace to get in that red. So real nice high probability setup here. Okay, folks, thanks for joining us. We'll be back next week at the same time over the weekend. Check us out at discoveroptions.com. Have a great rest of the week. Bye-bye.